That all day yesterday.
Live from New York City this morning. Good morning to all. About 20 seconds away, equity futures look like this. We're negative about 1/10% on the S&P 500, recovering this morning. On the Nasdaq 100, positive 0.5% on the Nasdaq. On the Russell, the small caps down about 1/3%. That's the opening bout. Switch on the board and get to the FX market. Euro dollar, the epicenter of everybody's focus, seemingly earlier this morning. Unchanged on the day, 100.41. Jordan Rochester of Nomura saying this one could go down to 95 later this summer in August. That's one to watch for sure. Yesterday, yields lower. This morning, yields lower again by 7 basis points, 292.07 on a 10-year going into CPI tomorrow. Crude pulling back 99.10 on WTI, down by almost 5 percentage points. And something that doesn't get talked about enough, including on this program, is China. The infection rate is climbing again. Most people suspecting in China's future is more COVID restrictions, and ultimately what does that mean for the commodity market? Marko Kolanovic of JP Morgan, we mentioned him earlier this morning. He's looking for a rebound in growth in the second half of this year, led by demand. Where? In China. What did Goldman do a little bit earlier today? Goldman had to downgrade their price target on copper to 6,700. They were out in the 8,000 something on copper. That's a big change. Let's get you some movers at the opening bell. About a minute in. Here's Abby.
John, that is a big change for copper, but relative to Amazon today, as the Prime Day starts, the first day of 2 Prime days, Amazon, little change, slightly to the upside, but it is a heavy weight, and actually it's come well off of its pre-market low, so now up about 0.7%. Investors cheering it to some degree. Investors also cheering PepsiCo up about the same amount. This, of course, after they put up a very solid quarter, importantly raised the outlook for a second time this year, saying that the consumer remains resilient, at least for those soda and chip products. So the staple sector pretty solid. Peloton really up quite nicely, up 3.5%. They're sending out the manufacturing of their bikes, so investors, traders encouraged that perhaps that will improve the margins. You were mentioning that downgrade over at Wells Fargo on Gap, John, down about 7%. Well, one of the headwinds includes, as you know, CEO Sonia Singhal stepping down, and also lots of other issues there as they bring numbers down. Gap not able to get out of its own way, John.
Abby, you were looking for that move in discretionary off the back of the move lower in crude. There we go, at 1% on consumer discretionary. Energy down by about 2.23% around the opening bout. We are positive 0.1% on the S&P 500. Big few weeks of earnings coming up. Dan Ives of Wedbush saying this: the street is already baking in a mild recession. Overall, we like this setup to own the beaten down tech sector into second quarter earnings season. The latest from the bull on big tech, Dan Ives. Kelly Lyons has more. Hey, Kaylee.
Hey, John. Well, beaten down sounds like almost a delicate way to put it, considering the Nasdaq 100 wiped $5.6 trillion worth of its value out in the first half of the year. And even if we are off the lows of the year so far, the index is still down about 27%. And for that narrower New York FANG index group of stocks, they're down 32%, of course, pressured by higher rates, which damages high multiple stocks more so given the value placed on future earnings. And pretty much all of the stocks in that NYSE FANG Plus index are down since they last reported quarterly results. The move smaller for the likes of Microsoft and Alphabet, but check out Amazon and Tesla, each down more than 20% since they last reported. And the next round of reports could catalyze even bigger moves. Bloomberg data shows that traders are bracing for price swings of anywhere between 4 and 13% for the FANG cohort, in part due to the fact that earnings estimates cuts just really have been lagging. So it leaves more room for big surprises and potentially more dramatic price action, because the street is still expecting tech earnings to be up about 13% this year. That consensus has not changed much over the recent months, even as the picture economic-wise has deteriorated. So even though we've seen valuations coming in, the Nasdaq 100 now trading at a forward PE ratio of about 21 rather than north of 30 we saw during the pandemic, that means that if you start to see something shifting in the E, if earnings estimates move lower, these stocks could still end up looking quite expensive, John.
Kelly Lyons, thank you. Brilliant work as always. Another downgrade in the last 12 hours. This time it is from Evercore and Julian Emanuel to 4,200, down from 43. Says this: a slowdown is unfolding, combined with a stronger dollar, labour market strain, supply chain issues, inventory builds, margins, EPS are under pressure as prospective recession scenarios develop. With the latest, here's Taylor Riggs.
And John, interesting, we spoke with Tracy McMillan of Wells Fargo yesterday, looking at earnings of $200, and the low right now on the street is about a 2 205. So you're really starting to see some of the revisions come in. I think this chart shows it all. I think the everlasting theme this year has been the optimism by the street, if you will, on some of the earnings guidance. But now actually on both sides of the pond, you're starting to see some of those revisions cuts finally start to come in. I think if you go to the next board, what you'll see is that sort of the year-over-year growth numbers, they've come down from the highs of maybe 5, 6, 7. You're now looking at just the earnings per share growth on a year-over-year basis of about 4%. But I think it's important to point out that number is still positive. When we talk about an economic recession, does that mean an earnings recession? It doesn't. Right now, there's actually still growth on a year-over-year basis. Take a look at this terminal chart. Kaylee was talking a lot about this, right? Sort of the forward PE guidance and how we're thinking about valuations. Yes, it does come like it's come down. Growth is still a little bit more elevated than value at the bottom of your screen. Overall, though, for the average, you're looking at about 16, 17 times, but those numbers have come down quite a lot, John.
Taylor Riggs, thank you. Looking forward to the close a little bit later with Romain Bostic and Caroline Hyde. Taylor leading the coverage there on the earnings you can expect and what it means for this equity market too. We've had some big calls in the last few days. This from Nomura caught my eye. Expect a recession to begin in Q4 22, the risk of an earlier start. They say we expect an additional 75 basis point hike in July, 50 in September, 25 in November and December and February 23. And then here's the call. We're already forecasting cuts on the street. This from Nomura, 25 basis point cuts per meeting, likely starting September 23. Taking the rate down to 0.875% by the end of 24. I'll say this up front before what I'm about to say. Nomura's been great on the Fed so far this year. They were calling for big hikes when other people weren't. But I'd love to borrow their crystal ball for 2023 because I can't get beyond August right now. BlackRock says the world has changed. They say the world has changed a lot. They write the following. We're braving a new world of heightened macro volatility and higher risk premia for both bonds and equities. The regime is not necessarily one for buying the dip. They go on to say policy will not quickly step in to stem sharp asset price declines. BlackRock's Jean Bavin joins us right now. John, it's great to catch up with you. The great moderation is over. Talk to me about what's replaced it.
Back to a more volatile future. The title of our mid-year outlook is what we are in, I think. And I think, just to make the core point here is a lot of the logic I think we are trying to tend to gravitate to is applying the old business cycle playbook, the things that have worked for the last 40 years, which we don't think they'll be working going forward. So the great moderation is over. To our mind, that means that this last 40 years where we were able to see both growth and inflation volatility basically be very subdued has changed. It's already the case for the last 2 years. And we think this is persistent because the reason behind it is we're in a world that is really shaped by production constraints. This is the pandemic restart, but it's more than that. It's also the climate transition that's going to continue to increase costs. It's also the fragmentation of the world. And that world is one that is not easy to navigate. It's going to be worse trade-off for central banks. They won't be able to stabilize it. And that's the world we live in now. So there's no Goldilocks, there's no soft landing in that world. And I think that's the main call we're making here is don't hope for that. It's going to be maybe a stable growth environment, but then we'll have more inflation or vice versa, but there's nothing really in the middle.
Jean, talk to me about then the kind of inflation number that you think we have to get used to, get comfortable with.
Well, central banks are talking as if they're going to try to bring inflation back to 2%, their target. Doing that and doing that quickly on the time frame that they're expecting it will have to imply a very dire economic cost. So that's why we're worried about recession, and markets are at this stage. So in the end, we don't think they'll deliver that 2%. We'll end up living with more inflation. We're thinking maybe something more like 3%. Which for the central bank world is not something. It's a lot above their target. So they will see that as a major miss of their objectives. But in the world we're living in, it's not so bad like a cost to live through given the alternative. So that's the kind of numbers we have in mind, like 3 more than 2 for the foreseeable future.
Jean, I was looking at your return assumptions, just short-term versus longer-term. Short-term, you're not constructive risk at all. I know that. That's front and center in the mid-year outlook. Longer-term, you are very constructive on equities. Can you tell me about your longer-term return assumptions and whether that's accompanied with a higher level of volatility compared to what we've seen in the last 10 years? Should I be expecting lower returns, higher vol? Is that going to be the change I need to get used to too?
So I think when you look over the next couple of years, the big bifurcation will be about whether we are right that we're going to live with more inflation, that's our call, or else is going to be one where we're going to see maybe inflation closer to 2, but a lot more volatility in growth. Under our baseline, which is living with more inflation, we think we're going to go through a burst of growth volatility, but that's going to taper off. And that's going to end up being positive for equity. So that's why we are constructive, as you say, on a more strategic basis. We think we have historical equity returns that can be delivered in this kind of environment. But we're tapering that off a bit because we think this is still going to be, we're not back to the Great Moderation. So I think we need to expect higher compensation for taking risk. And so historical to lower our return assumption on a 5-year basis if indeed we end up living with somewhat more inflation. If we come to the conclusion that central banks are really going to try to break the neck of inflation back to 2 and aggressively, which is the rhetoric they're telling right now, we don't think they're going to stick to that, but that's what they're telling us right now. In that world, then we would be starting to feel more negative, even on a more strategic, longer-term expectation.
Jean, that's risk, that's equities. Where do bonds fit in? I've spoken to a lot of people. I've got a long, long list of people now who think that we've seen the peak on a 10-year Treasury yield. They're pretty confident of that. They're saying you should bet against inflation. I see that in break-evens, Sean. That's what the market's been doing over the last several months. You take the other side of this, Sean. Walk me through how bonds and inflation protection fits into your view going forward from here.
Yeah, I think the main thing, again, and I'm going to go back to this because that's the core here, I think what is the most underappreciated feature of this new environment is that there's a much worse trade-off between growth and inflation. So you cannot have it both ways anymore. And so as a result, the inflation is not going to come back down very quickly. These supply constraints, these production constraints, even just from the pandemic, haven't even started to really unwind. So I think we're talking about many months of inflation persistence, and there are structural factors behind that. I have a hard time saying you can get 10-year at these levels if we're living in a world where inflation is going to be closer to 3. Break-even, a 5-year break-evens now at 2.1 doesn't make any sense for us. This is 2.1% 5 years out. Up to 10, we're going to be more in 2.5, 3%. So strong conviction there that this inflation is a bit too optimistic expectation from markets. And again, that's because the trade-off is much more acute than we've seen over the last 40 years.
John, we'll keep talking about this. We'll bring it home to the consumer as well in just a moment. Jean Bavin of BlackRock sticking with us. Equities right now at 0.4% on the S&P. This is a bounce back from earlier this morning. On the Nasdaq, we're up about 8 or 0.9%. Coming up, the health of the US consumer in focus with investors bracing for corporate earnings.
People are worried. Can we continue to grow earnings at the pace at which people are hoping for in what looks to be a slowing GDP growth, a weakening consumer?
That conversation up next.
People are worried. Can we continue to grow earnings at the pace at which people are hoping for in what looks to be a slowing GDP growth, a weakening consumer? And that growth is going to be really what drives confidence in equities and really what dictates the direction for the rest of the year.
We've got a little bit of everything this week. You've got economic data, CPI in America, then on to UMich and retail sales later on this week too. In the middle, you'll get an earnings sandwich from the big banks as well. We've had PepsiCo a little bit earlier this morning. Here's a line from them. Our updated full year guidance reflects the strength and resilience of our categories and consumer demand trends. Kaylee Lyons has more. Hey, Kaylee.
Hey, John. Yeah, a resilient consumer leading to the second growth raising forecast for revenue for Pepsi. They now say revenue is going to grow 10%. That's up from the prior 8% forecast, which already was up from the 6% forecast for annual growth that they had given originally. It's worth noting, though, that they maintained their EPS forecast. So faster top line growth isn't necessarily translating into faster bottom line growth. Analysts today, though, saying that likely is just an additional cushion given the inflationary cost pressures these guys are facing. Now, another point worth making here, yes, the company topped estimates in the second quarter, revenue up 5.2% overall, but unit volumes actually trailed that gain. Frito-Lay North America volumes, for example, actually down about 2%. So that indicates most of the sales gains came from higher prices, with prices up 12% across products as the company passed on some of that elevated input costs that it's facing. And then the ability to exercise that pricing power is really the differentiator in the consumer-facing sectors as the consumer maybe shifts its spending patterns in the face of inflation and fear of a recession. Now, Pepsi obviously falls into the staples category, a group that has held up far better than the discretionary sector this year. Discretionary, the worst performer in the S&P 500, down 30% year to date, John.
What do you make of that double punch on Europe, Kaylee? You get the FX story plus the weakness in the economy.
Yeah, it's a brutal one. The European, any company, multinational company in the U.S. that has to do business over there and is dealing with these FX headwinds as well, probably going to be a big theme, not just for Pepsi, but really across the board, John.
This is tough. Kaylee, thank you. Great word this morning over the foreign exchange story. Euro, dollar, you're getting hammered twice on the translation from euros back to dollars, and then the weakness that you get in the European economy right now too. Just on the energy story, not in Europe but in the US, Bank of America put out their card spending data in the last 12 hours or so, last 24 hours. This is what they had to say. Gasoline spending rose another 4% in June. These were month-on-month figures. It's up over 20% over the last 5 months or so. They say this has started to take a toll on other categories of consumer spending, including services. Spending on travel and restaurants fell for the first time since January. And you all remember what happened in January. That was the peak of Omicron. Back with us, BlackRock's John Bavin. John, help me here. The relationship between what is happening with energy, the price of energy, the cost of gas, fuel, all of the above, and what's going to happen with consumer discretionary.
Yeah, so that's I think there's a difference between Europe and the U.S. here that we want to make clear at the outset. I think it's a big deal for Europe. You talked about the exchange rate here, weakening euro. You know, we're talking about a shock for Europe that is of the magnitude of the 1970s. It's going to hurt the consumers there the same way it has in the 70s. That's why I think recession is kind of, you know, the baseline for the euro area as a whole. It's working for the consumers, the impact it's going to have on their purchasing power and so on. For the U.S., it is a headwind. It is something that is slowing down. On its own, I don't think would be enough to create like a real material slowdown, you know, purely from the demand destruction or consumer side. It's really that, but more the combination of that with the Fed aggressive hiking campaign, which eventually we think they'll pause and reconsider. But for now, they're pretty much on autopilot until the end of the year. And that's where the slowdown is coming from. But so the energy story is really, for us, more of a European story. And I think it plays into the euro-dollar exchange rate story you started with.
Jean, can we just focus on Europe a little bit more and get away from the mainland continent and get over to the UK? What we saw at Heathrow Airport today, putting a cap, a limit on passengers going through that airport and telling the airlines, that's it. Don't sell any more tickets this summer. Jean, I can't help but think that's not the end of that story. That in Europe, they're going to make some tough decisions about what should happen with capacity because of labour market constraints in places like airports, but also because of energy needs. Jean, what are you anticipating on the latter, on that front, on energy needs and the restraints, the capacity constraints that governments might start putting on these economies?
I think this speaks exactly to the core point of this environment is not the one we had, over the last 40 years. We're talking about the airport example is perfect. We're talking about a situation where we're not able to ramp up activity the way we used to be able to do normally. It's not like there's an unusual amount of flight that needs to go out of Heathrow. We're just not able to go back to where we used to be able to. And the reason being, as you say, labor supply. It's the labor shortage that is really preventing that from happening. So that is an anecdote that tells you the broader story that's going to take time to resolve. And by the way, this is also why this is not like this kind of logic of recession will ease off the inflationary pressure. We don't see that as the natural way to think about this. It's going to be production constraints that are so strong and hard that they keep putting inflation pressure at the same time as we see struggle to ramp up activity or even decline activity. So that's going to eventually, I think, ease up the pressure on commodities and oil and energy to some extent, but that's not the cause of it. So I see that more as a slight offset compared to the clamp down on supply that is happening through the geopolitical landscape and situation. So it's a small offset, but I don't think it changed a broader pressure upward on energy that we're facing
Jean, we've
globally.
just had a pretty long conversation, and I imagine sitting at home, I'm thinking of the S word right now, and I don't believe either of us have said it. Stagflation. Haven't you just described that in Europe?
Yeah, I mean, I think stagflation or, end of great moderation is what we're talking about exactly. So we're going to see a combination of inflation pressure continuing while growth is slowing. And that combination is one that central bank cannot stabilize as effectively as they've been able to for the last 40 years. And that's why either we're going to see a bit more inflation, somewhat more inflation, and that's going to be bad for bonds, or we're going to see more growth volatility, weaker growth, and that's going to be bad for equities. And that's kind of the more volatile environment that we are now living through and we have been experienced for 40 years.
Jean, it's been great to catch up. As always, sir. Jean Bavon of BlackRock on the latest on the equity market and a whole lot more for the outlook this year. We're positive 0.1% on the S&P, on the Nasdaq up around about 0.2. Coming up your trading diary, CPI tomorrow, then it's on to the earnings story. That's next. This is Bloomberg. We are about 25 minutes into the session. Equities look a little something like this. Positive 0.1% on the S&P 500. On the Nasdaq 100, positive by a little more than 0.1%. That's the price action. Let's get to your trading diary. The President speaking at 11:15 Eastern Time. I host the Fed Speak throughout the week with Barkin, Bostic, Bullard all on deck. US CPI out tomorrow. Then the President heading to the Middle East. The big banks kicking off earnings on Thursday with JP Morgan and Morgan Stanley. US PPI and another round of jobless claims coming up. Finally, consumer sentiment and US retail sales are out on Friday. We've got a busy week coming up. Looking forward to covering that with you. Thank you for choosing Bloomberg TV. For our audience worldwide, this was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
Minutes into the U.S. trading day on this Tuesday, July 12th. Here are the top market stories that we're following for you at this hour. Big test for margins. Financials kick off earnings season this week with margins and growth question marks. We got you covered. Morgan Stanley's Betsy Graseck and Peter Oppenheimer of Goldman Sachs. Euro's parity play. Eurodollar trades near 1-to-1. Curve stays inverted. Tech, though, finds a bottom. Now what? Your playbook into earnings. And I'm definitely not visiting Guy anytime soon. London's Heathrow Airport will ask airlines to stop selling tickets for summer travel, the latest pain for carriers. From New York, I'm Alex Steele, my co-host in London, Guy Johnson. Welcome, everyone, to Bloomberg Markets. Just in case I was going to buy that ticket this summer to come visit Cornwall, I'm not doing it because that is crazy. I don't think I've ever heard of an airport asking carriers to shut down like that.
Yeah, I think we're going to see more of it. To be fair, though, if you were to come and see me, you would get quite a good deal, in as much as the currency is definitely in your favor. The dollar is going up, up, up. Parity against the euro. We're not too far away in some ways on the pound. I suspect if you're trying to change money at Heathrow, you probably get it. So yeah, you could have a great time over here.
Well, in that case, I'm going to Paris, man. I'm not going to UK. I'm going to avoid Heathrow altogether and then take advantage of parity and buy all the croissants and red wine in Paris. How about that?
Yeah. Okay, that would be where I would splurge my money in terms of the shopping trip that I'm sure you're planning in the back of your mind. We are certainly watching that story develop very, very quickly. The question we're asking today, though, Alex, because you've taken us in a completely different direction,
You're welcome.
is what is happening with the margin story. We're about to get into earnings season. We're about to see potentially a margin meltdown. The two are not completely unrelated. We are going to see corporate results being very much affected by this strong dollar. But the margin story, I think, is going to be front and center. We get into the banks, first of all, clearly. So what does that mean? That means we need to ask this question, of course, to our Wall Street correspondent, Sonali Basak. We've got our cross-asset reporter. And yesterday's anchor did a great job yesterday. Katie Greifeld joining us as well. Sonali, let me ask you the question, first of all. What does a margin meltdown look like at the banks? We are very worried. We are watching carefully to see what's going to happen with loan loss provisions, what the macroeconomic environment is going to look like, but how will it actually crystallize into this bank reporting season?
It's a great question, Guy, because even though net interest income is expected to rise and banks are supposed to make more money on trading desks, given that the volatility is higher, but not stifling, you still have that issue that volatility really starts to stifle deal making and equity and debt issuance. So if you take a look at it, high yield spreads have already blown out quite a bit. They've come in a little bit, but they're still 2 percentage points higher than you've seen on average. That means when they're pumping the economy with money, when they're lending to clients, it is already getting significantly more expensive to do so. So you have a very double-edged sword here. Even though they are supposed to make money in some places, will they make enough money to really want to take on a lot more risk, especially when it comes to clients across different parts of the bank? I would also mention that this earnings season is starting in a phase of a 210 yield curve that is inverted significantly enough to make people worried about the future. And so all of those future comments about how willing they are to lend to risky clients and how much risk they're willing to take on into the future, everyone will be reading those tea leaves.
Yeah, and it's kind of the same thing with other companies as well, Katie, right? I mean, we all know the margin pressure has come, but it's how strong that top line will be and then how confident the CEOs have in their business model for the rest of the year, knowing that consumer demand can be very unpredictable.
And we are going to get these numbers. We know they're probably going to be terrible, even though if you look at some of the sell side estimates, not really coming down. But just listening to the mood music coming from C-suite executives over the past few weeks, it feels like some of this has already been priced in. I mean, if you look at the S&P 500 down about 19% year to date, the NASDAQ 100 down 27%. I mean, the question is out there, have we already priced in what we're about to get? We know the numbers are going to be really bad. But yet, I mean, the markets are a forward-looking vehicle. We'll see. There probably will be headline risk, and I would expect these single stock equities. This was the story last season, that there was so much volatility in the single names. But on the index level, I mean, maybe we're already there.
Katie, I'm going to try and weave in where Alex started, which was on what's happening at Heathrow. Heathrow has a labour problem. Which parts of the equity market also have a labour problem? Bloomberg Intelligence ran the numbers, and they're looking at stocks that have greater labour inputs into the bottom line suffering the most. Is that where we should be looking for the distinction here? If you are capital intensive, if you are labour intensive, that's going to be the distinction here in terms of the margin squeeze.
I feel like the labour costs are the wild card here, because we've been talking about the input costs, the price of everything going up, but labor costs, I feel like that was the wild card last season. When you think about Amazon coming out and saying that they were overstaffed, that took a lot of people by surprise, especially traders just looking at the reaction in Amazon. I believe we got something similar from Walmart or Amazon or Target, can't quite remember, but the degree to which some of these corporations, both in the tech sector as we learned and in the retail space, staffing up, trying to account for some of the incredible demand. Now we're sort of seeing the other side of that, where these companies have had to pull back on that, and that is going to be something really to watch in the next few weeks.
Yeah, and Guy, to your point, you know, if I look at the NFIB that came out earlier today, it was a terrible number, but specifically if you looked at those recipients that are looking at a better business environment over the next 6 months, that dropped by 7 points now to a negative 61%, and those are the guys that are really hiring all the people. So if you make stuff, maybe it's okay. If you're selling the stuff, maybe that's when we run into more problems.
Well, I just think, I think the smaller the business, the less opportunity it has to deal with the problem of the labor market. If you're a bigger company, you have maybe more opportunity to hire more easily. That's going to be a huge challenge for smaller companies. I think it's going to be the toughest place is going to be right at the bottom in terms of the size of a business. If you're kind of 50 or 100 person business, that's where I think the real pain is going to be felt here.
Yeah, Shonali, and I wonder sort of the distinction then to be made between big banks then and regional banks and then the credit card companies, because those guys, the two ladders, are going to be much more exposed to this kind of risk than, say, the JP Morgan.
It's an amazing question to ask because you look at how stocks are already trading. If you look at JP Morgan, Morgan Stanley, these tend to have not only large clients, but also high net worth clients. You have to ask yourself, is it just big companies or big companies that are also serving wealthy customers that are shielded from some of these inflationary concerns? Those two banks are trading well above book value, while many of the others are either at or below. Bank of America also, they say their consumer is in good shape, but what about, to your point, the rest of the country's banks? When you look at the loan officer data already, you see that in the first quarter, there was a lot of types of lending that was unchanged. And that was before the economic situation started to deteriorate more significantly and rates started to rise more significantly. So to your point, guys, you know, can companies not only withstand some of the margin pressure that they're seeing, can they get the things that they need, the revenue, the loans at an affordable price to make it towards the next step of this economic cycle?
Katie, final quick question to you. If I strip out energy, how different does the picture look?
It looks pretty different. I mean, just in the last few weeks, it feels like the bloom has come off energy stocks. But if you look at the sector level, it stuck out to me this morning that if you look at consumer staples, they are the outperformer other than energy, only down 5%, only 5%. You compare that again to the S&P 500, down 19%. It really shows you what is front and center in investors' minds. It's which of these companies can actually pass on these higher costs, protect their margins a little bit, and it seems like it's consumer staples.
And then last quick question from me, and Katie, I'll throw this to you. The other wild card seems to be what happens with the dollar. We already saw Microsoft warm with that. The Bloomberg Dollar Index up by about 5.5% in the second quarter. Have we already priced in that dollar strength, or do you expect kind of more potential downgrades or warnings to come?
I would expect that we're going to see it a lot in earnings calls, talking about those FX headwinds. I mean, Microsoft kicked us off early with that warning back in May, but I would expect that it's going to be a common theme as we really dig into some of these reports.
It's going to be fun. I'm excited. All right, guys. Thanks a lot, Bloomberg, Shonali Bassik, and Katie Greifeld for joining us. We appreciate it. So coming up, we're going to continue the theme. Second quarter earnings starting to roll out. Goldman's chief global equity strategist, Peter Oppenheimer, expects profit margins to contract. By how much? We'll break that down. He joins us next. This is Bloomberg.
Earnings season is here.
It's a low bar going into earnings season.
There are bargains out there to be had.
Bloomberg is fastest with the numbers and analysis.
There's conflicting and complex cross currents. Strap yourself in for this earnings season.
Bloomberg, the fastest numbers and analysis you trust.
I think the story for the next year is gigantic margin compression from really extraordinary levels, which obviously poses a question for equity investors because of earnings compression. But from the Fed's perspective, from market perspective, what it means is that the pace of disinflation over the next year, I think, is likely to be quite a lot quicker than markets expect.
That was Pantheon's Ian Shepherdson earlier on Bloomberg Television. That takes us back to our question of the day. Are we about to see a margin meltdown? I want to put that question to Peter Oppenheimer, Chief Global Equity Strategist at Goldman Sachs. Peter, it's a lot to break down. Let's just start in the U.S. for a moment. Are we prepping for a margin meltdown? Is it going to happen?
Well, I think we will get margins coming down, and that's typical as you get economic downturns. Margins are very sensitive to that. And in a sense, really, the surprise of the last quarter was how well both revenues and margins held up. Now, some of that was because actually nominal GDP, which companies are making a claim on, has been quite strong because of higher inflation. But it's also because you had a lot of pent-up demand and savings following the pandemic. And many companies were able to pass on those higher costs. And that's beginning to wane, I think. So certainly, it's not just that earnings are going to be weaker. The market is expecting that, even though consensus numbers have yet to come down. But it's really the forward guidance and the margin that I think is going to be of greatest interest. And that's the area of greatest vulnerability, I think.
Is that priced, do you think, Peter?
It's priced to the extent that, from the best we can tell, looking, for example, at how the most economically sensitive companies have been performing relative to those that are quite defensive, for example, a mild recession is being priced on both sides of the Atlantic, a slightly deeper one in Europe. But I don't think the market is really poised for any significant or prolonged recession. Now, to be fair, there are some important supports. Private sector balance sheets are quite strong, banks, households and corporates. And in the case of Europe, at least, there's quite a big fiscal boost that's helping to support growth as well. But I do think earnings numbers will still come down quite a bit. And whether we end up with a recession or not, I think there's a good chance that markets will price that probability as being higher than they have done as yet.
So, Peter, does your base case incorporate a potentially recessionary or slowdown in that we get the margin squeeze now and then we get weaker demand later? Is that your base case?
That's right. Yes, it is. Our base case is based on our economists' central forecast, where they have only a 50-50 probability broadly of recession as they define it. But we are expecting much lower numbers than the consensus.
Right.
As I said, consensus numbers really typically are quite slow to come down at turning points. Markets tend to move a lot quicker. And we should say also that equities tend to start to recover from bear markets 6 to 9 months before earnings begin to improve. So, as you said earlier, they are about anticipating the future. And some of this downturn has been priced, but not enough. And I think, as perhaps you were saying earlier, valuations are not really yet at levels consistent with recessions, particularly in the US. And I think there's probably more valuation compression that can come through.
Peter, can we just deal with the top line and what happens in the middle of the P&L and the sequencing as to how this is going to unfold? At the moment, we're starting to see margin pressure coming through. Costs are rising, be it labour costs, be it sort of input costs more broadly. So that's starting to impact what is happening in the middle. At the top, inflation is supporting a top line, plus, as you say, actually the macroeconomic backdrop with savings relatively strong continues to support the top line. Are we, though, as we go through into the recession, going to see the top line weakening, but the margin squeeze easing? Or does the margin squeeze continue because actually the pressure on the labour market is going to be maintained and actually the supply chain story doesn't ease, and you end up with the worst of both worlds? The top line comes down, but the margins continue to, the input cost story remains relatively high, because that's a 1-2 punch that is going to really have a big impact on the bottom line.
Yes, and that sequencing is not unusual going into downturns. It's really a question of to what extent do you get top line and margin moderating, and which sees the greatest pressure. Now, I would say actually revenue growth, top line, is not likely to be so weak, and that's partly because inflation is higher and nominal GDP is higher. Also, remember, there still is a lot of pent-up demand that we're seeing. The discussion you've just had about airports is a very good example. It's not that there's a lack of demand, it's really an issue of supply. So I think revenue growth can hold up, but costs are still going to rise.
But if I just to jump in here, the fear for Heathrow, the fear for European airlines is that you have this huge surge this summer, nobody can cope, margins get squeezed, unions get decent pay rises, those are sticky, but come the autumn, actually demand collapses, but the costs are still there. That's the fear. How big a risk is that for equities?
Well, it's a risk from a structural perspective, because I think you have to look at where we've come from. Context matters a lot. If you look at profit margins, they've been rising relentlessly for the last 20 years and reached all-time record highs in the US and close to that in other regions as well. And there's lots of reasons why margins have done well. Uncontained globalization, very plentiful and cheap commodities and labor for a long period of time have contributed to that as well. And as we get more regionalization, less growth in world trade, and as you say, energy and labor is more scarce and more expensive, we would expect margins to begin to come down. Part of that is cyclical. You tend to get margins weakening in an economic slowdown. And part of it is probably structural as well. And that's why we've been arguing that investors should be focused less on revenue growth, which was what they rewarded above all else in the decade after the financial crisis, supported by very, very cheap interest rates, and focus more on the quality of balance sheets and margin sustainability within and across sectors, because I think that will become more valuable as an attribute.
Is there also the possibility here that we get too pessimistic when we look at all the challenges, like you said, and I understand the sequencing into a slowdown, but JP Morgan strategist led by Marko Kalanovic talked about how most investors are already positioning for a recession and sentiment is weak, and if an economic disaster doesn't materialize, risky assets can substantially recover. What would be your take on something like that? And if there is a recovery, where might we see it first?
Yes, well, I would agree that the markets and most investors are increasingly anticipating or positioning for the worst, for a recession. It's not inevitable that we get recessions, or certainly deep and prolonged ones, bearing in mind some of the other supports that I mentioned. You know, labour markets are still very strong, private sector balance sheets are healthy. In the areas that are most at risk, like Europe, you're also getting fiscal support. So if a recession is not as bad as investors eventually end up pricing, there will be a good recovery. And typically, the recovery from a bear market is triggered by a clear peak in inflation and interest rates. So that would be one of the important things to look for. And initially, it would likely be a strongest rebound by the areas that have fallen the most and the areas that are most levered to an economic improvement. I think what happens after that, though, is going to be a different story with slower returns for some time to come.
Peter, final quick question from me. Europe, basically, we're waiting, we're watching, we're trying to understand what A, Russia's going to do, and B, what China's going to do. In the meantime, it looks like a very bleak environment. So the question we've been asking a lot of our guests today, it's our MLive question of the day, is a recession in Europe inevitable? What's your perspective?
Again, I don't think it's inevitable. Where our economists are basically looking at stagnant growth in the second half of the year, with Germany and Italy that are more exposed to Russian gas in particular being in recession. A lot will depend on what happens to gas supplies as we move forward into the latter part of the summer and beyond. And that will determine whether there's a broad recession, and I think how deep. One of the benefits, as I would say, of Europe, though, is that there is a fiscal expansion coming through, and many governments are already intervening to try to reduce the negative shock or moderate it from a real income squeeze to protect consumers to some degree. It won't prevent a recession. It may moderate the extent of it. And do bear in mind at least that European markets are much cheaper. They're trading roughly at around 10 to 11 times PE. That's below the long run average. Maybe not at really stressed valuations, but certainly starting to look quite attractive. And we think the dividends broadly are sustainable over time. So there is some value beginning to come through there.
Peter, great to have some of your time today. Thank you very much indeed for sharing it with us. Peter Oppenheimer, Chief Global Equity Strategist, joining us from Goldman Sachs. Thank you very much indeed. This is Bloomberg.
It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Rishika Gupta. American Airlines is sticking with its expectations for a jump in second quarter sales despite rising costs. In a filing, American said total revenues are expected to be up 12% in the period compared with the same quarter in 2019. Meanwhile, costs for each seat flown a mile will also rise about 12%. And PepsiCo has raised its outlook for the second quarter in a row. The maker of Mountain Dew, Fritos and Quaker Oats expects revenue to grow 10% this year as consumer demand remains resilient. PepsiCo's North American food and beverage business remains strong during the quarter. Meanwhile, demand for convenient foods helps international markets continue to perform. And Peloton is taking one of the most dramatic steps yet to simplify operations and reduce costs. The company will quit building exercise bikes and treadmills at its own factories. Partners will now handle manufacturing. Peloton is making the change after several months of turmoil. The company cut nearly 3,000 employees earlier this year and shares down some 75% this year. And that is your latest business flash. Alex, Guy?
All right, thanks so much, Ritika. So this could actually go a long way in helping build up its cash reserve, Guy. And at the same time, they're trying to move people more to this subscription model. They have 2.66 million subscribers, so they could do that, cut their costs there, and still only hike membership fees a little bit. Maybe they have a chance to really grow their subscriber base here.
When you think about it, what would you want to do right now if you were a company that was struggling? You'd want to provide as much simplicity as you can. And simplifying the supply chain looks like a really logical thing to do. Why would you have an internal and an external supply chain? Why would you go with that dual structure? Why don't you just go with one of them? For instance, an external supply chain, remove the risk from you, put it somewhere else. As you say, focus on the service side of the business. That's ultimately, in theory, where the value is. I appreciate that some technology companies like Apple do very well off the hardware, but a lot of value has been created in services recently.
Yeah, you also have to wonder too, like how much has the pandemic boost been wrung out? Like has it all been? Like can we now really value the company on its fundamentals rather than COVID? I don't know. I thought you were going to ask me what would I rather do, be on a Peloton or go for a run or something, and I was like, I'd rather NAS, thanks.
Well, yeah, of course.
Obviously.
That goes without saying.
Yeah. All right, coming up, U.S. bank earnings kicking off Thursday. We'll look ahead with Betsy Graysick. This is Bloomberg.
Web, this is Bloomberg.
I also think that interest rates could go up a couple hundred basis points and not throw us in a recession, because I think that there's been just so much capital sloshing around that I think, you know, the first kind of major swallows of reducing that excess flow, I don't think are going to have quite the impact that the stock market is reflecting.
That was David Rubenstein's exclusive interview with real estate titan Sam Zell. Always fun to get his perspective. You can catch that full interview tonight at 9 p.m. All right, we're about an hour into trading. I got to say, it's hard to find a direction here. Bloomberg's Abigail Doolittle is tracking some of these whippy moves today. Abigail?
Well, Alex, you're right about that. It certainly is hard to find a direction. This is an intraday and overnight chart of the NASDAQ 100 futures, and you can see for the most part down, starting slightly higher, though, last night. And then around the time of the open, up sharply and now back down. So net, a small loss, but lots of moves to get there. As for a pocket of strength, we have lots of names